Hello, it's Craig Larson with Larson Financial Advisors for the market message on August 22nd, 2014. Hope you've been enjoying your summer. Hard to believe it's almost over. Just wanted to give you a quick update on financial markets. The broad rankings have not changed very much. U.S. stocks are still out in first place versus other asset categories. Commodities, which have been in 6th out of 6th place for a couple of years now, briefly muscled up to 5th place and now have fallen on their face again. So it's been really hard to find any investment category that can compete with U.S. stocks. As we've talked about, third highest valuations in history, record high margin debt on the exchange. There's definitely some risk there. So it hasn't yet changed the trend. At some point it will. We won't know until we start seeing some weakness, but so far so good. We had the little 4% pullback in August, just a little blip on the radar. Kind of overdue for that bigger correction. So watch for that. We'll be watching out for that and keep you posted. Now, on the fixed income markets, institutional investors are now going for more risk. Okay? When we look at bond yields, which are the things that pension plans like to invest in, U.S. government bond yield for a 10-year Treasury bond is only 2.34% as of last week. German government bonds, 10-year yield is 0.95%. Japanese government bonds yield 10-year 0.5%. So pension plans and institutional investors who usually want to own these fixed conservative investments are now embracing more risk. As an example, city of San Diego in California, it's about $2 billion short on its pension plan, about 21% underfunded, has recently voted to allow derivatives to be used in the pension plan to boost returns. Now, you might remember the term derivative. Back in 2008, they were called financial weapons of mass destruction because they took out a lot of firms, nearly took out many more, caused a lot of damage because people were using them to turbocharge returns. Now, when we look at total derivatives in the world financial marketplace, we're almost about double the amount of derivatives than we were in 2006. Not quite double what the peak was in 2007 before the big crash, but getting close. So here again is a kind of a sentiment indicator. Investors are reaching for risk, embracing risk, probably taking too much of it. Personally, I think it's going to be a big train wreck for San Diego and any other institutional investors that are messing with derivatives and government bonds. So we want to, as individual investors, reassess our risk tolerance. Make sure you're not venturing too far off into the minefield just because you're frustrated with low interest rates. So if you have any questions about how to manage those things, give me a call, send me an email with any questions. Be glad to try to help you out. In the meantime, enjoy the rest of your summer and have a great day.